For many people, retirement is supposed to be the reward, a time to slow down, enjoy life, travel a little, and spend more time with family after decades of working. But for a growing number of retirees in the United States, something unexpected happens when that phase begins. Even after leaving full-time work, their tax obligations don't disappear, and in some cases, they become more complex. Social Security benefits can be taxed, withdrawals from retirement accounts create new liabilities, and investment income continues to add pressure in the background. Combined with rising living costs, many retirees begin asking a simple question: why am I still paying so much in taxes after I've stopped working? Today, we're going to break down why this happens and the legal strategies retirees use to reduce their tax burden and keep more of their retirement income. Retirement doesn't mean tax-free income. One of the biggest misconceptions about retirement is that income stops and taxes disappear with it, but in reality, retirement income is simply structured differently and still heavily taxable. Social Security benefits can become partially taxable depending on total income. Withdrawals from traditional 401ks and IRAs are generally taxed as ordinary income, and even part-time work or small consulting income can push retirees into higher tax brackets than expected. This creates a situation where retirees are no longer earning more money, but are still being taxed as if they are. And the core issue is that most people do not fully understand how their income will be structured until after they retire, at which point their tax situation is already largely locked in. Required withdrawals can increase your tax bill. After a certain age, many retirement accounts require withdrawals, whether the retiree needs the money or not, and these are known as required minimum distributions, or RMDs. The challenge is not just the withdrawal itself, but how it stacks on top of other income sources. Because if a retiree already receives Social Security and possibly investment income, RMDs can quickly push total income into a higher taxable range. This can trigger higher income tax brackets, increased Medicare premiums, and reduced eligibility for certain tax benefits, meaning that instead of retirees controlling their income timing, they are often forced into taxable situations that significantly increase their annual tax burden. The hidden tax problem inside retirement accounts. Most people spend their working years building retirement savings inside tax-deferred accounts under the idea of paying taxes later, but later is where the complexity begins. Every withdrawal from traditional retirement accounts is taxed as ordinary income rather than capital gains, which means long-term savings can still face relatively high tax rates depending on timing and total income for the year. When multiple withdrawals happen in the same period, whether planned or forced, they can create a sudden spike in taxable income that surprises many retirees, turning what appears to be financial freedom into an ongoing tax management challenge. Why timing matters more than total savings. One of the most overlooked factors in retirement taxation is timing, because two retirees can have identical savings but end up paying very different taxes depending on how and when they withdraw their money. Large withdrawals in a single year can push income into higher tax brackets, while smaller, structured withdrawals, spread over time, can keep taxable income more stable and reduce overall tax exposure. Strategies such as Roth conversions, planned withdrawal sequencing, and coordination between different income sources all influence how much tax is ultimately paid across retirement years. And in this system, it is not just about how much money you have, but how strategically you use it. Location, healthcare, and invisible tax pressure. Taxes in retirement do not exist in isolation, because where a retiree lives can significantly change their overall tax burden, with some states taxing retirement income heavily, while others provide partial or full exemptions on Social Security or pension income. Healthcare also plays a major role because as taxable income increases due to withdrawals, Medicare premiums can rise through income-based adjustments, creating a ripple effect where higher income leads to higher healthcare costs. On top of this, property taxes, insurance, and inflation continue to add financial pressure, and while each factor may seem small individually, together they shape how long retirement savings can realistically last. Legal strategies retirees use to reduce taxes. Despite these challenges, retirees do have access to legal strategies that can significantly reduce tax pressure when used correctly. These include spreading withdrawals across multiple years to avoid income spikes, using Roth accounts strategically to generate tax-free income, managing investment sales to stay within favorable capital gains brackets, coordinating Social Security timing with other income sources, and in some cases, relocating to more tax-friendly states. The objective of these strategies is not to eliminate taxes entirely, but to reduce unnecessary spikes and create a smoother, more predictable income structure throughout retirement. The real shift in retirement planning. Retirement today is no longer just about accumulating savings, but about managing how those savings are taxed, accessed, and distributed over time. Many retirees who experience financial stress are not necessarily undersaved, but are instead poorly structured from a tax efficiency perspective. And the difference between financial strain and stability often comes down to planning, timing, and understanding how the tax system interacts with different income sources. Once these rules are understood, retirees gain significantly more control over their financial outcomes than they initially expect. If you found this video helpful, subscribe for more retirement, Social Security, and personal finance insights designed to help you protect your savings and make smarter financial decisions. And if you know someone who is retired or approaching retirement, share this video with them. One conversation today could help them avoid a costly mistake tomorrow. Thanks for watching, and I'll see you in the next video.